Hi everyone. In this lecture, we will discuss how to determine the fair value of futures contract. If you recall, in previous videos, we explored how businesses manage the risk of price fluctuations by entering into a futures contract. But have you ever wondered how these future prices are calculated? While market forces influence the price, there is also a theoretical formula to determine the fair value of a futures contract. So, in this lecture, we will take a closer look at this formula. Future pricing involves determining the price at which the futures contract trades today for a delivery at a specific date in the future. So, in finance, we typically use either annual compounding or continuous compounding to determine the future value of an investment. So, let's take a closer look at the difference between the various compounding methods. Let's walk through a simple example to understand how compounding works. Imagine you invest rupees 10,000 at an annual interest rate of 10% for 1 year. We will see how the final amount changes depending on whether the interest is compounded annually, semi annually, quarterly, or continuously. So, with annual compounding, interest is added only once at the end of the year. So, after first year, 10,000 into 1 plus 10% will give us 11,000. Simple enough, right? You earn rupees 1,000 in interest by the end of the year. So, in case of semi annual compounding, interest is applied every 6 months. So, instead of waiting a full year, you get 5% interest halfway through. After 6 months, your money grows to 10,500. So, in the next 6 months, you earn 5% on 10,500. So, the total becomes 10,500 into 1 plus 5% gives you 11,025. Notice that you end up with 11,025, a little more than 11,000. Why? Because the second time you earned interest on both the original amount and the 500 interest from the first 6 months. So, in case of quarterly compounding, interest is applied every 3 months. So, each quarter you earn 2.5% interest. So let's do the math. In the first quarter, 10,000 into 1 plus 2.5% gives us 10,250. And in the second quarter, 10,250 into 1 plus 2.5% gives us 10,506.25. In the third quarter, 10,506.25 into 1 plus 2.5% gives us 10,768.91. In the fourth quarter, 10,768.91 into 1 plus 2.5% gives us 11,038.13. So, with quarterly compounding, your 10,000 grows to 11,038.13. The more frequently interest is compounded, the higher the amount. Now, let's imagine the interest keeps building every second. So, this is called continuous compounding. In this case, we use a special number called E. Now, E might sound a bit technical, but don't worry, it's just a constant like pi. So, the value of E is approximately 2.718, and it shows up a lot in math representing exponential growth. So, 10,000 into E to the power 10% gives us 11,051.71. So, your money grows to 11,051.71. So, it's the highest amount, but as you can see, it's only a little more than quarterly compounding. So, the key takeaway, the more often interest is compounded, the faster your money grows. In case of annual compounding, you get 11,000, semi annual compounding 11,025, quarterly compounding 11,038.13, continuous compounding 11,051.71. The difference isn't huge, but it shows how frequent compounding helps your money grow just a bit more every time. Now, let's move on to the formulas used to compute the fair value of the futures contract. In futures pricing, the cost of carry model plays a key role. It explains that the fair price of a future contract includes not just the current spot price but also any costs involved in holding the asset until delivery, such as your storage fees, insurance, or the interest on borrowed money. Simply put, the longer you need to hold the asset, the higher the total cost, which in turn increases the future price. So, here is a quick look at the formulas used for both annual and continuous compounding. Okay. Let us start solving numericals to understand the concept better. SBI is trading at rupees 803 in the cash market, which is the spot market. So, what would be the price of SBI futures contract expiring 3 months from today if the risk free rate of interest is 6.5% per annum? So let's find the fair value of the future contract using both annual and continuous compounding methods. Let's begin with annual compounding. So future price is equal to spot into 1 plus risk-free rate of interest to the power t, which is time to expiry. So let us plug in the values in the formula. So spot price is 803 into 1 plus risk-free rate of interest is 6.5% to the power 3 by 12, which is our time to expiry. So once you plug in the values in the formula, you get the answer as 815.74. So the fair value of future price of SBI with annual compounding is rupees 815.74. Now, let us compute the fair value of the futures contract using continuous compounding method. Here we use the formula future price is equal to spot into e to the power risk-free rate of interest into time to expiry. So spot price here is 803 into e to the power 6.5% into 3 by 12 will give us a future price of 816.15. So the fair future price of SBI with continuous compounding method is rupees 816.15. Let's move on to another example with dividend income. When a company pays a dividend, it's basically handing out a part of its profits to the shareholders. Now, think of it this way. Before the dividend is paid, that money is a part of the company's total value. But after the company gives it away as a dividend, the value of the company and its stock decreases by the same amount. So, if a stock is trading at 100 rupees and the company announces a rupees 5 dividend, the stock price will likely drop to 95 rupees on the ex dividend date. Ex dividend date is a day after the dividend is announced. This happens because anyone buying the stock on or after the ex dividend date won't get that 5 rupees dividend. They are only buying the remaining value of the company. So, it's like a cake. If you cut a slice and give it away, the cake is smaller. Similarly, when dividends are issued, the company's stock price drops by the dividend amount. I hope this is clear. Now, let's start solving a problem. Calculate the future price of ITC Limited if the spot price is rupees 450. The annual risk-free rate of interest is 6% per annum and the dividend of rupees 5 per share is expected in 4 months. The contract matures in 6 months. So the first step is to calculate the present value of a dividend expected to be received in 4 months. Since the dividend will be received only after 4 months, we cannot directly subtract it from the spot price. Instead, we need to calculate the present value of the dividend expected to be received after 4 months and then deduct the value from the spot price. So present value of dividend is equal to future value of dividend divided by 1 plus r, which is a risk-free rate of interest, to the power t, which is time to expiry. So let's plug in the values in the formula. So dividend 5 divided by 1 plus 6% to the power 4 by 12 gives us 4.903. Now, the second step is to deduct the present value of the future dividends from the current spot price and then calculate the stock's future value. So the formula used here is stock price minus the present value of dividend into 1 plus r to the power t. So let's plug in the value. So 450 minus 4.903 into 1 plus 6% to the power 6 by 12 gives us a future value of 458.25. So the fair future price of SBI with annual compounding is rupees 458.25. Now let's move on to continuous compounding method. The first step is to calculate the present value of the dividend expected to be received in 4 months. So here the formula used is d into e to the power minus rt. So 5 into e to the power minus 6% into 4 by 12 gives us 4.9. Now let's deduct the present value of the future dividend from the current spot price and then calculate the stock's future value. So the formula used here is spot price minus dividend into e to the power r minus t. So spot price is 450 minus 4.9 into e to the power 6% into 6 by 12 gives us 458.65. So the fair future price of SBI with continuous compounding is rupees 458.65. Now let's move on to another example with storage cost. The current spot price of turmeric on the NCDX, which is National Commodities Derivatives Exchange, is rupees 13,070 per quintal. A trader wants to determine the fair future price of delivery in 6 months. Assume the risk-free annual interest rate is 7%. The storage cost for turmeric is 1500 per quintal. Calculate the fair future price of turmeric in 6 months. First, let's take a closer look at the storage cost. When we talk about storage cost for turmeric held over 6 months period, we are looking at several key expenses. First of all, there is a rent for the warehouse where the turmeric is stored. This is essential for keeping the product safe and secure. Next, insurance comes into play. It's important to protect the turmeric against potential damage or loss, whether from pests, moisture, or accidents. Finally, there are maintenance costs associated with the storage facility itself. So, this includes things like keeping the environment suitable for the turmeric so it doesn't spoil, which is particularly crucial given the climate in many of the turmeric growing regions in India. So, all these factors together make up the total storage cost and they significantly impact the pricing strategy for traders and producers. Now, let's move on to finding the fair value of turmeric, which is going to be transacted after 6 months. Let's start with the annual compounding method. First, add the storage cost to the spot price of the turmeric, which is represented as U in the formula. Then, as usual, find the future value. So the formula here is spot price plus U, which is the storage cost, into 1 plus R to the power T. So 13,070 plus 1500 into 1 plus 7% to the power 6 by 12 gives us 15,071.32. So the fair future price of turmeric with annual compounding is rupees 15,071.32 per quintal. Now let us move on to continuous compounding method. The formula used here is spot price plus U, which is a storage cost, into E to the power risk-free interest rate into time to expiry. So let's plug in the values in the formula. 13,070 plus 1500 into E to the power 7% into 6 by 12 gives us 15,088.97. So the fair future price with continuous compounding is 15,088.97 per quintal. So we have come to the end of the lecture. To sum up, future pricing is about balancing the current price, interest, and the cost of holding an asset. Understanding this makes it easier to manage risks and trade smoothly in the market. Thank you. See you in the next video.